Thank you, everybody, for registering for our CEU class this morning. And Tommy is going to start presenting in just a few minutes. But the reason we're able to do a lot of this stuff is because we have generous business partners who support our chapter. They invest in our chapter year after year. And 3 of them are on this webinar. And they're just wanting to say, wish you good morning and say a few words about their company. So I'm going to start with Sheila Lee with Centennial Bank. Good morning.
Good morning. Thank you, Karen. Centennial Bank's a long-term proud sponsor and member of CAI. We love this organization, so thank you. Everybody may be wondering, who is Centennial Bank? Well, we are operate under a parent company that's called Home Bank Shares, that's headquartered in Arkansas. We are a 5-star Bauer rated bank with $16 billion in assets. And we are proud to say that for the 3rd year in a row, we are on Forbes' list as one of the best banks in America. We also made it on the list as one of the world's best banks. So we are very proud of that designation because we don't get that designation without being at the top of your game and being one of the best that there is. We have 76 branches in the state of Florida. We operate all the way from the Panhandle down to the Florida Keys. We have an association banking team designated specifically to handling associations. We help you with your FDIC investments, we help you with your lockbox, and we have lending expertise. So everyone on our team is licensed as a community association manager. So we have that knowledge and we have the education requirements that help us understand the statutes that govern your communities. So that helps us better serve you. I want to say that, Craig Fink is the leader of our team. He is on the CAI board for Centennial Bank. And with that, I just want to say that we are out there in the community. If you need us, we're virtual. We can be in person if you need us to be. Just look for us. We also give back to the communities that we serve in. We're out there teaching classes, the CEU's education classes that we write. You'll see publications from everyone on our team. So we are out there giving back to the community. And with that, I just want to say to everyone who banks with Centennial already, thank you. We appreciate your business. And for anyone who does not bank with us, we always appreciate the opportunities. So thank you very much.
Thank you, Sheila. And now I want to introduce Pam Lutz with Concrete Painting and Restoration.
Good morning, everyone. First and foremost, I want to give kudos to CAI. This is definitely a trying time, and I know that this is our first inaugural manager all day spread over 3 days, 2 hours each day. So that's a big feat, and I really appreciate all that they're doing to keep us up and running. And to all of you managers, I know this is a tough time and you're trying to learn a new normal, as we all are. My name is Pam Lutz and I'm with CPR, Concrete Painting and Restoration. We are your full service exterior painting and waterproofing firm. We've been a diamond sponsor for 2 years here with CAI West Florida chapter. And as many of you know, I'm on many different committees because I absolutely love CAI and the staff. Some things that set us apart as a painting contractor is that we are licensed general contractors. How does that help you as a manager? It helps you because if you run across any unforeseen projects that come up during the painting, we can pull a permit. We work with all the engineering firms so that if we need help from an engineer, we definitely can use them as well. We have painters, we have carpenters, we have stucco experts, we have concrete experts on staff with our company, and we are located right here in Sarasota. We have 2 offices, one in Tarpon and one in Sarasota. We are locally owned and operated. Donnie Morlock is the owner. But basically, we are here to help you in any way that we can. I know that this is a weird budget season, but if you're coming up for a budget bid, we'd love the opportunity to work with you. And the one tip that I will give to managers is that when you get to that final point where you're looking at the companies, please take a moment and interview the different contractors and find out what they bring to the table, because all painting contractors are not created equal, and you will find that definitely is a good thing to have somebody that can carry the project from start to finish. We have a lot of references, which I'm always happy to provide, and we work with a lot of the managers within CAI. So again, I just want to thank you guys for participating. Thank you, Karen, for letting us be a diamond sponsor and letting me participate on so many different committees. And I hope everyone enjoys the class. Tommy is quite entertaining, and he will do a great job, I'm sure.
Thanks, Pam. I appreciate it. And Tommy's got his sponsor hat on right now, not his hat on, because Atlas is also one of our diamond sponsors. So with that being said, I'm going to let Tommy talk about Atlas for a couple minutes.
Yeah, thanks. And Pam, thank you for the segue. It's going to be different trying to be entertaining through this virtual platform, but I'll try. So this is a whole new thing for me. As I was telling Karen before, I haven't done any webinars yet where I've taught the class. So just to talk a little bit about Atlas. As many of you know, Atlas has been in the Sarasota area for over 65 years. I've been with the company for 24 years. Dave, who's also on our condo team, has been with us 20 years. And most of our staff has all been with us over 10 years that work on the condo team. And I think that's really important as we look for things, because one of the things we really pride ourselves on is consistency. We're consistent in everything we do, whether it's good, bad, or ugly. We're consistent about it, which is important. So our motto is we don't like surprises in insurance. We don't like giving them, and we don't like getting them. So we try to keep the associations always in the loop on what's going on. Primarily, we work on the west coast of Florida. I'm kind of old school when it comes to insurance. I know a lot of companies out there go all over the state and all over the United States. I think you need to have your agent locally. So if your building burns down or if you have an accident, they need to be over there within a half hour holding your hand and telling you how the process works. We've been a member of CAI since 1999. I remember when the meetings were over at the Anthony's and the Quay, and some of y'all were all there. So just happy to be a diamond sponsor as well. Y'all are going to hear enough from me today, so I'll end it with that, and we can get into the fun stuff.
Okay, Tommy, thank you. Again, managers, these are 3 of our 7 diamond sponsors that really support our chapter and are the reason that we've been able to keep going through this pandemic. We did plan for recession, but we never planned for a pandemic. So they are the ones that keep us going, and we appreciate all of you. With that being said, Pam and Sheila are going to leave us. Tommy's going to stay because he's got to teach. And Tommy, if you will, go ahead and share your screen. And managers, during the presentation, Annie with Tommy's company, Annie Thompson, she's monitoring the chat. So if you have questions during the seminar, go ahead and ask them through chat. And Annie and Tommy Annie will make sure Tommy gets the question and answers it. With that being said, Tommy, I can see your screen, so we're good to go. And like I said, I'm going to mute and I'm going to close my video so that I'm not a distraction. But if you need me, I'm right here.
All right. Thanks, Karen. I assume you guys could all still see me, so I'll try not to do any weird facial expressions or pick my teeth or anything. We're going to get right into it today with the class. Many of you have maybe taken this class in the past. The devil is always in the details. I've kind of changed it up a little bit from the last time because there's a lot of stuff going on in the insurance industry that I think we need to talk about right now, that more or less the elephant in the room. So diving right into it, today's learning objectives, and a couple housekeeping things before I get started is, if you do have a question, send it through chat. Like Karen said, Annie's monitoring it, so she could send me a little message and I'll answer the questions. These classes go a lot better when I have questions, or if you have something you want to say or an example of something, just go ahead and share that with us, because one of the things about these classes that I've done in the past is I learn a lot through the classes, not only by giving you information, but I usually learn something from y'all because you are on the front lines and you see what's going on out there. And there's always some crazy story that I walk away from a class going, oh my gosh, I haven't seen that. So if y'all want to share that or have any questions, please, I encourage you to do that because that's really helpful for everyone. So that being said, our learning objectives, I'm going to go through the agenda. We're going to go through our learning objectives. I'm going to give you, just because it's that time of year, the hurricane preparedness update. I'm not going to go too deep into that, but I want to go over the things that everyone forgets every year. Your board members and managers sometimes forget that really when disaster hits, they really need to know how it works. I also want to talk about the changing marketplace, because after about, I'd say since 2005, we've been through a soft market cycle. We're entering what we call in the insurance industry a hard market. So there's drastic changes coming this way for insurance. And I think most of you have been briefed by the agents out there that work with the condo associations to kind of give you an idea of the changes in the marketplace. What I'd like to do is kind of tell you why it's changing, kind of dig a little deeper into that. So when you're talking to your boards about why the budget needs to go up or why a deductible may change, you can kind of have a background of why this is happening. The other thing I want to talk about is COVID in your insurance policy. This has been a question over the last couple months on, hey, how does my insurance policy work? Does it respond? Do I need to do anything? So we're gonna talk a little bit about that. I'm also going to talk about the importance of a performance bond. Many of y'all are going through capital improvements, and I get this call quite often about, hey, we're re-roofing our buildings, or we're redoing our balconies, or we're paving our parking lot. What should we have for insurance and bonding for our contractors? So we'll talk about the importance of a performance bond and what it does. We'll also talk about transfer of risk. One of the things the insurance companies that are writing general liability are really looking at now is they're looking to try to limit their liability. And one of the ways that we limit liability is we transfer risk. All right, I have a question coming in. And it's, I asked the treasurer if she wanted me to get bids to see how much the insurance company is doing. I'll address that when we get to the changing marketplace, because I don't want to jump out of the agenda too much here, but I'll address that. So then we're going to talk about transfer risk. One of the things, like I was saying, the general liability policies, there's a lot of claims, and the insurance company, that market's changing as well. So one of the things they're looking at doing is making sure that the associations can transfer as much risk as possible. And this really deals with the subcontractors y'all are working with. So we'll talk a little bit about that. Then we'll go into endorsements, warranties, and representations, which is really the meat of the policy. This is the scary stuff. When I name the class, the devil's in the details, everyone says, well, you know, we go out, we get bids on our insurance, but like Pam mentioned, that not all painting contractors are the same. Not all insurance policies are in the same. So when you go to look at these insurance policies and you compare them, you really need to look at these endorsements, warranties, and representations, because the policies can vary greatly. And I'm going to talk a lot about this. And then the last item we're going to do is the covered and not covered, which is always a fun part, because we'll take actual examples of claims that are going on in associations that I've had to deal with and that have been dealt with in the industry. And we'll talk about whether they're covered or not covered, and how they're covered, or how we could get them covered if they're not covered. So we're going to talk about a lot today. Because we don't have as much interaction, I'm probably going to run through this without a break, if that's okay with everyone. And then I'm also probably going to end a little early because we don't have a break. I'll take all the questions and comments, but we're gonna roll through this. So getting right into it. Going on to our learning objectives. Whenever I talk about learning objectives and I talk about insurance, one of the things is I do not want you to become an expert in policy form. You're not a licensed insurance agent. Leave that up to the licensed professionals to know the policy forms. What y'all need to know is just that they're out there and how to recognize them in the policy. So you need to know that when I look at a policy and I see a virus exclusion, that exclusion's in the policy. I then need to call my expert and ask him, how does that exclusion work? So really the goal here is not for you to become an expert. Okay, I also want you to realize that all policies are not created equally. Like I said, insurance policies are going to vary from form to form, especially now as we go through the harder market and we're dealing with a lot more non-admitted companies or companies coming into the marketplace. These companies historically put a lot more endorsements or exclusions on the policy. So we really need to recognize what's going on with those policies. So if you have a company that's offering a general liability policy, you need to look at that form page and make sure that the exclusions match each other or the endorsements match each other, because it could make a big difference. I had an association the other day I was working on that said, hey, Tommy, you know, I got a quote for a property insurance that's lower than yours. And I go, wow, that's really interesting. Let me take a look at the form. And sure enough, their form had a endorsement on the policy that paid for roof on an actual cash value basis. Well, that decreases the type of coverage greatly. So it wasn't an apples to apples comparison. I was given a replacement cost. They were getting an actual cash value valuation on the roof. That's like apples and oranges. In the case of a hurricane, if their roof blew off, I was paying to replace it where they would get a depreciated amount on the form. So you really need to look at these things. So all policies are not created equal. I want you to be able to not interpret the endorsements, but you need to be able to locate the endorsements in the policy. And I'll kind of go through where to find them. I always tell people, when you get an insurance policy, everyone starts at the front to look at the premium page. All the good stuff is in the back, because that's where the insurance companies slip in and put in all the endorsements and exclusions and how the policy works. So you really want to start at the back sometimes and look at what's going on in the policy there. Okay, we're going to review some examples of endorsements, exclusions, which can change the form. And then we're going to talk about exposures within an association. Because sometimes you have an endorsement on there and you'll have the choice between not having it or having it, and the price will be different. I think you have to have conversations there with boards that discuss what is the risk as well. Okay, I always use the example of like, there's a firearm exclusion out there now in general liability policies. Well, sometimes you can buy the general liability policies and it's drastically less expensive with the firearm exclusion. Well, a lot of associations will then measure their risk. If you have a 2,000 unit association with a drastic amount of renters and facilities and all that, their exposure may be higher to that 5-unit condo where every neighbor knows themselves. So you have to kind of measure the risk when you're talking about these. All right, diving right in. Okay, first thing we're going to talk about is understanding your policy in the event of a hurricane. So my goal today is not to tell you how to prepare for a hurricane or what to do in a hurricane. My goal is to not have any surprises when the hurricane hits. And sure enough, every year during hurricane season, after an event, I get about a lot of calls. After Hurricane Irma, our agency got 600 calls probably within the first week of Hurricane Irma. And people were calling to report damage. And I will tell you that about 75%, about 75% of those calls, there was no claim. And it's real easy because they didn't understand how their deductible worked. So we try to talk about deductible till we're blue in the face when we go out and meet with the associations, and we walk through how their deductible works. But sure enough, when the claim happens, they call and they don't understand the deductible, and then they are surprised when part of the claim's not paid because it didn't meet the deductible or something like that. So in Florida, we have a varying differences in deductibles. Okay, so most of your insurance policies are going to have some type of deductible for their windstorm or hurricane coverage. And that's usually a percentage of the insured value. So what you'll see out there is you'll see a 1, 2, 3, or 5% typically. The 1% you'll usually see on newer buildings because the insurance companies know that the newer buildings hold up better. So they'll say, hey, I'll give you the 1% on a newer building. So that's typically not available to the older buildings. If you have it on an older building, you're very fortunate and you want to keep that deductible. But 2, 3, and 5% are the typical deductibles. Here's where it gets confusing because you have to look how that deductible is worded. So if you look below, the deductible could be worded 3 different ways. And these 3 different ways have a tremendous amount of difference. So if you have a percent wind hail deductible, that's a percent for a deductible in any windstorm claim. So if you have a tornado in February that comes in here, you have a percent deductible from that. There's also a named storm deductible and then a named hurricane deductible. Well, what's the difference between a named storm and a named hurricane? Well, a named hurricane only applies in the event of a named hurricane. A named storm only applies in the event of a named storm. So a tropical storm would fall under the named storm hurricane, the named storm deductible, whereas that would not fall under the hurricane deductible. The best scenario for the association in this situation is you want a named hurricane deductible if available. Most of your admitted carriers in Florida provide a named hurricane deductible. And that's the easiest way to remember things because your percent will only apply in the event of a named hurricane. So all other perils or all other types of wind losses will apply to an all other peril deductible, okay? But as we move through this marketplace and these non-admitted companies are becoming more in the mix, you'll start to see wind hail deductibles, named storm deductibles, and named hurricane deductibles. In fact, I've seen some policies that have all 3 deductibles on the policy, and I'll kind of walk through an example of how that works. There's also a per occurrence and a calendar year deductible. So you may see on your policy that you have a named hurricane calendar year deductible. That's kind of what you want because that way, in the case that you have multiple hurricanes in one year, you're only subject to that deductible once in that calendar year. So we try to get associations to have a named hurricane calendar year deductible. If it's not possible, you may have a named hurricane per occurrence deductible or named storm per occurrence deductible. So you really have to look at that language because the deductibles are going to vary greatly. So let's kind of get into a little example on this to kind of walk you through how this would work. So when the event does happen, you know if you have coverage or not by the amount of damage you have from the wind. So, okay, so we'll use 123 Main Street Condo Association. They've got a replacement cost coverage in the policy for $15 million. Their policy contains, I'm going to use an example that they have all 3 of these things in the policy. They have a 3% named hurricane deductible per calendar year. And then they also have a named storm other than hurricane per occurrence deductible and a $10,000 all other wind per occurrence. You're not going to see this too much, but I exaggerated the example so you guys could see what it looks like. Okay, so let's see what happens in the case of these wind losses. Okay, Hurricane Roger is rolling through here, and hopefully that's really late in the season. With a name like Roger, you hope that's not happening in August or it's going to be a really bad season. So let's say Hurricane Roger causes damage to the association in the amount of $550,000. They take off the roof, and the damage is $550,000 from the hurricane. How much will the association receive from the insurance carrier? Well, we know Hurricane Roger fits a hurricane, okay? And the hurricane is per calendar year. This is the first loss of the year due to hurricane. So they have a replacement cost of $15 million. 3% of the 15 million, you take 15 million times 3%, you have a $450,000 deductible. You've got $550,000 in damage. So you take $550,000 minus the deductible. So the association is getting $100,000 out of that $550,000 in damage. I cannot tell you how many calls I got where an association called and said, hey, you know what, we had some roof damage. I go, oh, sorry to hear that, during Hurricane Irma. I was like, have a roofer out there. Let's make sure the roof is sound, make sure everything's in place, and have them provide a quote or a proposal to repair the roof from the loss due to the hurricane. So a couple days later, they call me back and say, we have $5,000 in roof damage. Well, when we calculate the deductible, well, it's like, you've got a $30,000 deductible. So those are hard conversations to have with associations. So I'd rather have those conversations before the loss than rather after the loss, because then they're going, well, what do we buy insurance for and all that? And I get it, but it's better to have those conversations always before the loss. Okay, so Hurricane Roger, they're getting $100,000 out of that $550,000 claim. Okay, 2 weeks later, Hurricane Sally rolls through. Okay, and hopefully this doesn't happen, but if for y'all that have been in the business for a while, you guys remember 2004, 2005 Hurricane Charlie, Jean, Francis, Rita. Those were years where we had multiple storms. So I had a couple associations here locally that actually had damage from multiple storms. So what happens there is if you have a calendar year deductible, that hurricane deductible only applies per calendar year. Okay, so back to the example of 123 Main Street, they have a $450,000 calendar year hurricane deductible. Remember, the key here is Hurricane Sally caused this damage. So their deductible is based on a calendar year deductible. So they have $450,000 that they already paid in the first storm. They paid that in Hurricane Roger. So they don't have to pay that again. So in that second storm, the association is going to receive the complete $300,000 because the deductible doesn't apply because it already applied. They paid it all in Hurricane Roger. So this is a reason that we do want to report hurricane claims, even if the deductible is not reached, because if you have $100,000 in hurricane damage in the first storm, that could offset the deductible for the next storm. So we want to make sure that we have that reported, so we can, if you have an additional storm, we can offset the deductible. So very important to understand that. All right, so we no longer have a hurricane deductible. All right, 2 weeks later, this is a really, really bad year for 123 Main Street. A tropical storm comes through. Tropical Storm Tom causes an additional $65,000 damage. Well, how much will the association receive in proceeds? Well, we know it's not a hurricane because it's called Tropical Storm Tom, okay? And we already had Roger and Sally, and they have a calendar year deductible for their hurricane. But so they have it in their policy, they actually have a named storm deductible in addition to the hurricane deductible, named storm other than hurricane deductible. So they have $65,000 in damage. And we already talked about it, that they have $50,000 named storm other than hurricane deductible, and that's per occurrence. So they would only get $15,000 from the insurance company. Okay, because it's not a hurricane and it's other than named storm wind deductible other than hurricane. All right, so then 6 months later, an F4 spring tornado causes $1.2 million in damage to the association. Okay, so this storm does not have a name. It's not a hurricane. It's not a tropical storm. There's no name. So what we call this is other wind coverage or that. So they have a $10,000 all other wind peril. So they have $1.2 million in losses minus 10,000. I made a typo there. It should have been 1,190,000. I'm sorry. So they would only pay the 10,000 and the insurance company would pay after that. Okay. You know deductibles now. You have this information. This is the biggest, I want to say, call we get after an event. We try to tell people this every time we meet them. I want to talk about deductibles because there's no surprises. And this is a big number for a lot of associations. A lot of associations will have 30, 40, $50 million in insured value. And when you're dealing with deductible, even if it's 2% on a 50 million, that's $1 million deductible. They need to know that that's out there, because they're going to have to pay for it, and it's usually going to come in the form of an assessment to the unit owners. I usually try to break it down and say, okay, if you got $1 million deductible and you got X amount of units, I take the number of units and divide by the deductible, and that's a potential assessment for each of the unit owners. But this is a conversation we need to have and constantly reinforce, because we don't want surprises. Surprises are not good when it comes to asking them for money. So, all right. Any questions yet on that?
Yeah, I think Bob just wants you to address his questions here. So he was asking if they could go out to get bids, and this was the reply.
Okay. So Bob asks, his insurance renews in November. I asked the treasurer if she wanted me to get bids to see how the insurance company is doing. November, typically your agent, how the process works, and I'll give you our process, and how I think most agents that work in this in the condo world game goes, is 120 days in advance of the renewal. The insurance companies allow, it's either 120 or 90 depending on the company. They allow the agent to submit for a quote or an option. So what the agent will do is they'll send it out to the carriers they represent and ask for a quote 120 days or 90 days in advance of the renewal. The insurance companies typically will not release that quote, because they're not obligated to release that quote until the last minute. The incumbent company that actually writes the insurance will go ahead and release it, because statutorily, if it's an admitted carrier, they have to release some terms in advance of the renewal. This is typically 30 days. Most of the companies are working within that 30-day period, and there's a reason for it. A lot of these insurance companies in Florida buy a heavy amount of reinsurance. They're largely reinsured. So they have a certain limit of capacity in their reinsurance. So as they're putting quotes out, they are measuring how much insured value they have within their reinsurance program. Because let's say they have $1 billion in reinsurance and they quote out $1.5 billion in business. If they end up writing all of that, they're going to be $500 million short in their reinsurance program. So they really measure this. And I know it's hard because boards want this as far in advance as they can possibly have it, but it just doesn't exist. So you're probably not going to be able to see your exact numbers prior to 30 days in advance of the renewal. They are looking at it. They are modeling it. They're working on it, because your agent has sent it to them 120 days or 90 days in advance of renewal. So they are looking at those things, but you're probably not going to get your exact figures more than 30 or 45 days maybe out.
So the agent can go out. I think they're getting, the treasurer is confused between an agent and another agent.
Yeah, so okay, so the other confusion goes, I guess, is a lot of boards think, okay, I can go to 3 agents and they're going to get me a quote with the same company. It doesn't work that way in the marketplace. The insurance companies will give the quote to the first agent that submits the business to them, okay, or the incumbent agent. So if I'm the agent and I have ABC Insurance Company, that quote from ABC Insurance Company is only going to be released to me. It's not going to be released to the 10 other agency association called. The reality of it is your agent, if they're doing their job and they're a community association expert, like many of the CAI members are, they're going to go to all the same insurance companies. Okay, so they're all going out to the same insurance companies, and they're getting really the same rate and terms as each other. So you really, when you go out to this process, it's really picking your agent who's going to give you the service and provide the value and the expertise you need, because the pricing is not going to vary from agent to agent. The companies have filed rates with the state. They can deviate from those rates for certain things like wind mitigation claims and stuff, and they use modeling now to model your association. So the price is a price. So if you have an agent telling you, I can get you a better price with ABC Insurance Company than, than your current agent, they're wrong. That's just not the way it works. So I hope that answered the question. Did it?
Yep.
Okay. So talked about hurricanes, always fun. Talked about deductibles, always fun. No surprises. That's our motto, no surprises. All right, changing marketplace. So this is a great segue going into the marketplace change, because the marketplace is going through a massive amount of change right now. Like I said, insurance goes through hard markets and soft markets, okay? For many of you managers and board members that have been in this business a while, you know this is how it works, because prior to 2004, after Andrew, we were in a hard market where we saw insurance premiums going up 40, 50, 60% a year for 4 or 5 years in a row. Then around 2005, we started seeing them level off, and we went through a soft market cycle because we didn't have a lot of hurricanes after 2007. And so we had more companies coming into Florida to write insurance, and premiums went down. So we've been in what we call a soft market cycle. And what happened in that soft market is premiums went down, deductibles went down, we were able to get ordinance of law coverage, we were able to get some mold coverage, and everything was rolling along really, really nicely in the insurance marketplace. Okay, so the saying in insurance is what goes up must come down, what goes down must come up. We are now entering a hard market in insurance, and the industry is predicting that this hard market's going to be around for 3-4 years, and that's usually how the cycle works. And that could even be more if we get some increased catastrophic disasters. What's causing the hard market? Okay, there's a number of things causing it. One, there's been an increase in large natural catastrophic claims, hurricanes, wildfires, earthquakes, etc. And when we talk about this, everyone says, well, we didn't have one here in Florida. Yes, we know that, but the reinsurers reinsure globally. So when they put their reinsurance pricing in, they price it according to what their losses or their combined ratio is. So the reinsurers took it in the pants over the last couple of years and basically have gone to the insurance companies and said, okay, we need to increase the rates because of our losses, and the insurance companies need to do. Unfortunately, Florida is always going to be probably the first place the reinsurance carriers run to get a rate increase. We live on a peninsula and we're prone to hurricane. So the reinsurers are always going to come to Florida companies first and say, we need an increase in premium. So since 2017, insurers in 2017 posted $135 billion in losses. That was actually a record for catastrophic losses. So you think about Katrina, you think about 9/11, you think about all these events that happened. 2017, a combination of those events was a really bad year. There was $86 billion in 2018, and then there was some improvement in 2019. So these insurance companies are actually paying these claims. They're taking in a lot of premium. Don't get me wrong, but they do pay out a lot of claims. So that's going to lead to higher reinsurance pricing. Like I said, your Florida domiciled companies, the companies that are writing property in Florida, and that's basically pretty much most of them, all of them, rely heavily on reinsurance. And they need to, because they need to be able to pay the claim, and they want to be financially solvent and be able to meet the obligations of their policy. So if you're dealing with an admitted carrier in Florida and they're buying a tremendous amount of resources, and that makes you rest easy that the claim is going to be handled correctly, because they're going to have money in place after the catastrophic event happens. But they're getting, their pricing is going up, and they have to pass that on to the consumer. That's the only way. So, I talked to some carriers, and over 50% of every dollar they collect, So if you're with ABC Insurance Company and your premium's $100,000, $50,000 of that premium that insurance company is collecting is going directly to the reinsurance bill. So so they are collecting a huge amount of reinsurance, and that pricing is going up. There's also, because of the claims, one of the ways insurance companies make money is they make money on their investments. So they bring in a tremendous amount of premium and they pay out a tremendous amount of money in claims. But that lag time that they have before they pay out the claims and collect the premium, they collect investment income, whether it's interest or investments. Well, what has happened is the interest rates have fallen. So their results, they're not making their money off their investment income because the interest rates are falling. And they can't, typically insurance companies aren't going into risky investments in equities or IPOs or something like that. They want to invest in bonds or something that they are not going to lose the money, because they have to. They have to keep the money in the bank to pay the claims. So when their interest rates go, they can't offset their claims with investment income. So they're not making money on the investment income. The last thing is, many of the insurance companies, many of the rating agencies, AM Best, Demotech, and Fitch, have come out and said, we want to review your financials. We want to make sure you're prepared to pay the claim. We want to make sure that you're financially solvent and you're doing the things to make sure the policy holders are made whole after a claim. And this is really the way that you as policy holders measure an insurance company, is you rely on the rating agencies. You rely on them to do the homework and report to you how their finances are. So these rating agencies have an obligation to you to make sure that these insurance companies are financially stable. So what has happened is they have gone in and they have made some financial requirements more stringent of the companies. So what the companies had to do in order to keep their rating, and their A rating or their excellent rating, is they've had to infuse more capital into their surplus or assets, or buy more reinsurance, so the rating agencies would keep their rating. So this has put some pressure on the carriers to keep more money in the bank. So all of these things are causing the property rates to go up. Okay, so what do you do? Okay, so everyone says, well, you need to shop it. Okay, well, go ahead, but it is what it is, because there's not a lot of folks writing condo associations out there. So more or less, your agent's probably getting you the best pricing he can get, okay? So boards are gonna have to start to really look at things from a perspective of premium, how to offset it, okay? And I kind of talked about this. Let me talk about what I see going on right now. And this is from Towers Watson, which is kind of tells us the industry, what's going on. So for rates this year, we're going to see non-cat, which is other than wind, those are your fire rates. So if you have a association policy where you're still buying your wind coverage separately through another carrier, your non-cat coverage, which is your fire coverage, it would cover like lightning or a water leak, you're going to see anywhere from a 5 to 15% or higher on that line, okay? Your cat, which is your wind coverage, we call it CAT, it's catastrophic, is your wind coverage. If you haven't had any losses on your association, you're probably going to see anywhere between a 10 to 20% increase next year in your premium, or possibly higher. And I'll kind of talk about the things that could push that higher. And that's if you had no losses. If your association has had some losses and you have some your cat wind, you're going to see 15 to 30% increases. If you've had multiple losses or some losses that are, extraordinary, you're going to see higher than that. Okay, what type of properties are being affected? We always see that the higher increases are going to be seen for older properties that have not had updates, particularly to the roof. So when we go out to the marketplace and we talk to insurance companies, the first question they always ask is, when was the building built? If we say you were built in 2005 or 2008, they'll quote that all day. You may not even see a rate increase. You may see a very minimal rate increase because your building's built to the new code. So we know those buildings hold up really, really well. If you were built before 2001, the next question they ask is, hey, when was the roof replaced? And can you tell me about that roof replacement? So if you have these properties that have older roofs that haven't been replaced, we have some that have these tile roofs that haven't been replaced because they're still holding up. They don't need to be replaced. Insurance companies look very unfavorably like that, and you're probably going to see a larger increase on those properties. Also, any properties on the barrier island or frame construction, you may see some increases in those as well, on the higher side. Risk with that adverse losses. In the soft market, it was funny, you know, insurance companies were very eager to write your business. There's a lot more competition, and sometimes they look at claims not as strongly. We're starting to see the carriers really look at claims again. So your associations that have had multiple losses or a lot of water claims, they may see higher increases in their premium as well. One of the things that's also causing the higher increases that I didn't touch on is the carrier consolidation. Because of the marketplace, you'll see a lot of the carriers are consolidating with each other to bolster their financial ratings, to keep their ratings. And there's always consolidation in the industry. And then the other thing is we see a lot of companies that are kind of withdrawing from the marketplace, or they may be partially withdrawn, where they may have said, you know, a couple years ago, we don't mind writing those high-rise buildings, but now we want to withdraw from that marketplace, or we want to go here. So this is causing accelerated market deterioration because there's a less competition, and competition is always really good for the associations, and it causes the market to be soft. We're seeing carrier consolidation and market withdrawals, which is causing some increased pricing. So what is the association going to do? Okay, we're going to have to start having these conversations. So if you look back, and for those of you that have been in the business for a long time, you'll probably remember when 5% or 3% deductible was the norm. Okay, many of your associations have gone to a 2% or 1%, or have gone back down to a $2,500 deductible. Or maybe they had a sublimit of ordinance of law for 2.5%. Now they have 10% coverage. So the conversations you're going to have with the agent at renewal are pretty simple. Okay, the agent's going to come to you. He's going to show you your 15 to 20% rate increase or whatever it is, and then he's going to say, here are some options. Okay, we know that the association sooner or later need to keep these premiums in check. We've brought all the companies that have said they'll give you a quote, all 4 companies, and max amount of companies that actually quote the thing and offer terms. And here's the numbers. Okay, if you want to reduce that 15% rate increase and bring it down to 5%, you can go from a 2 to 5% deductible. And that's really the questions you're going to have and the discussions you're going to have is, can we increase deductibles? Can we reduce some coverages? Are we okay with doing that? Do we feel okay doing that to offset the premium? And these conversations are going to have to come up. And I think that's at renewal. That's going to be the job of your agent to really explain the risk involved in that. And there's going to be exclusions on the policy that you guys need to discuss. And are you okay with accepting that? And we'll kind of go into those a little bit. Another thing I think that's going to change, and you're going to see this, is many of your companies are going for property in the open. Remember years ago, it was really tough to find coverage for carports and lights and sheds and gates and fences. I think we're going to start to see that be a challenge as well. I think a lot of companies are going to start to pull back on writing these types of items because we know that, okay, you may have a building that was built in 2002, but that fence doesn't hold up like the building. So the insurance companies got whacked a little bit on the last couple of years. So I think we maybe see a reduced capacity or an adjustment in pricing on those items, which is something that the associations may want to discuss. I mean, do you need to cover that $20,000 fence and pay $500 in premium for it? So those are the conversations. Any questions?
Yeah, one question.
We have one question. How do legal claims settlements influence next year's premium? They definitely will affect next year's premium, okay? Claims are always affecting premium. And unfortunately, the carriers don't differentiate legal settlements and liability. So if you have some claims, you're going to see, depending on the frequency, the amount of the claim, if it's a shock loss and you don't have multiple claims, the insurance companies usually can live with a shock loss because it's a one-off, and claims are going to happen. We realize that. We're in the insurance business and claims are going to happen. But if your association has multiple trip and falls on sidewalks where they're paying out or they're defending, there's going to be a challenge. So you're going to have the conversation of, okay, one, we're dealing with a higher insurance pricing, and two, the job of your agent is to really get out there and work with you to tell a story to the insurance company about how you're fixing this problem so it won't happen again. Right now, we're dealing with a lot of associations here in our area. They're getting to that age where they're 10, 15 years old and their sidewalks are lifting. Okay, the tree roots are growing, the sidewalks are lifting. So what we're starting to do is we're starting to see trip and fall claims. You know, Mrs. Smith walking her dog down the street, trips on an uneven sidewalk, injures herself, and sues the association. Okay, what the insurance companies want to see, one, they don't like these claims because they're, you know, they have to pay out on them. But what they want to see is that you're taking a proactive measure to fix these problems before they happen, or right when they happen, you're fixing them. So we need to be proactive in sidewalks. How much it affects your premium is going to depend on the frequency and the severity. I think frequency is more of an issue than severity. If you have a one-off claim, you're probably not going to see that premium go up that much. If you have a frequency, you'll probably get a non-renewal from your carrier. And then you're going to have to go into the open marketplace and go with a company that may have a more exclusions and deductible, and you're going to pay a much higher price than that. Typically, your general liability is not the big portion of your premium in a condo association. The premium that is fluctuating in the condo association really deals more with the property, because that's the big number. So if you're paying $4,000 for your general liability, but you're paying $90,000 for your property, if you have a general liability increase of $1,500, that's not hitting you like a 15% property increase. So I hope that answered the question. All right. So, oh, I got another one. Does having either a person gate guard or virtual protection on community associations affect premiums? It doesn't affect the premium directly, meaning that there's no credit for having a guard or an automatic gate. What it does do is when we tell the story to an association, gated communities will have less claims for vandalism, for theft, things like that, and they're better monitored. So insurance companies, when we're shopping the general liability, will typically like those gated communities. It's a nice story to tell. So I guess direct premium, maybe not a like a credit like you would have on your auto insurance for having a seatbelt. But what it does is it opens up more carriers, maybe a carrier that doesn't want to write a neighborhood, maybe look at it because it's a gated neighborhood, or they have a 24-hour guard. So it does help. I will tell you one thing with the guard, they do not like armed guards. So if you have an armed guard, good luck getting insurance. Okay, so non-armed guards is what the insurance companies want. The other thing, the insurance companies, we always have a problem with insurance with on the property side is the gates going down and crashing on a car. So we actually get a lot of claims from property and liability on that, which could cause your claim frequency to go up. So hope I answered that question. All right. So changing marketplace, talk a little bit about that. Good stuff. It's happening. So no surprises. That's the motto. Don't like giving them, don't like getting them. So if you're hearing things like this similar from your current agent, you heard them from me now too. There's really no way around them. We're going to do our best and and hope for the best. And keep in mind, when I have these conversations, I always try to be as conservative as possible. That way, you know, I'm an insurance agent, so I live in a worst case scenario, I guess. So I try to be as conservative as possible, and we hope for the best, that maybe these increases won't be as high. So we're working for you. Okay, COVID and your insurance policy. I can't tell you, when COVID started to hit right away, we were getting calls. Hey, what's the insurance company requirement? What are they doing here? You know, what do they want us to do? How does it work? Okay, so the insurance policy for COVID. Okay, most of your general liability, most of your associations have a general liability policy, and they have a directors and officers policy. So those are the two coverages that will be most applicable in the event of a claim arising out of COVID. I'm going to give the typical insurance disclaimer here that every claim is handled on its own specifics, so I'm not trying to adjust a claim here for you. So if there is a claim that rises up, each claim is going to be looked at individually and based on their specifics. But in general, the general liability policy is what protects the association in the event a claim is brought against them for bodily injury or property damage. Bodily injury in that definition says sickness too, okay? So should someone get hurt on the premises, whether it's a trip and fall or anything, and say that the association somehow caused their injury or sickness, this would be covered under the general liability policy, okay? So we look at the general liability policy and say, well, you know, a sickness is defined as a injury. So if the association is legally liable in some way, they will have defense and coverage under the general liability policy. There's a couple things here that we don't know how the general liability policy will work, okay? Because the general liability policy also says that it must be triggered by an occurrence. So is a COVID exposure an occurrence? That's up for interpretation, and I think the courts will probably figure that out. Maybe some of your legal experts can give you some of that. But in general, the liability policy should respond to COVID claims, unless there's some exclusions. And many of your general liability policies have exclusions in their policy, okay? So part of this class is the devil is in the details, okay? And I talked about not all insurance policies being equal. So you need to check your general liability policies for some exclusions. Okay, one exclusion out there is a communicable disease exclusion. And, you know, unfortunately, it's quite common in many of the association policies. So if a COVID incident happened and your policy has a communicable disease exclusion, the insurance company would deny the claim and deny defense of it, okay? So if you have the communicable disease or virus exclusion, you may have an issue if there's a COVID claim, okay? This is a typo. The fungi bacteria is separate from the virus, okay? So whoops. So virus exclusion, communicable disease exclusion, you want to see if your policy has that. Unfortunately, some of them do. Okay, so you need to manage your risk a little bit better when having these exclusions on there. So the other exclusions are the fungi and bacteria and the pollution exclusion. Those are exclusions that are pretty much in all general liability policies. And I put these in here because the insurance industry, depending on the state you live in, and we live in Florida, the definitions in the policies really don't view COVID as this. You need to view your specific form, but COVID probably doesn't fit the fungi or bacteria exclusion, and it doesn't fit the typical ISO exclusion for pollution or expected or intended injury. Those exclusions are applying, but I wouldn't worry too much about them. If you have a communicable disease exclusion, you need to really, that's the one that if it applies, you need to address it in a more risk management. If not, general liability policy should apply if you don't have the communicable disease or virus exclusion on there. And read the forms on the other. So the other part of the policy that addresses it is directors and officers coverage. And I know a lot of y'all have been to seminars where where you've been told that, hey, your D&O policy doesn't cover COVID. And they're completely right, because directors and officers policies will never cover bodily injury. Okay, they're excluded on every directors and officers policy out there. Why are they excluded? Because your general liability picks up for bodily injury. Okay, so when you're told your D&O doesn't cover claims for exclusions due to bodily injury, yes, it doesn't, because it's always excluded. But if you look at the definition in your general liability policy, who is an insured, the board of directors is protected under this policy as who is defined as an insured. So you should have protection under your general liability policy unless one of the exclusions applies. Your D&O coverage will provide coverage for non-bodily injury claims arising out of the COVID. It should. And I always give this example because I've had a lot of associations call who've decided to keep their facilities closed. And that's up to them. You do what's best for your association. The insurance company is not going to tell you what to do there. We'd rather have your council and the boards decide that. But let's say you decided to keep your facilities closed, and the owners start to say, well, I'm paying these dues every month, and you know, this is a financial loss and we want to bring a claim against the association. This is something that we would probably apply to the directors and officers. There's no bodily injury, so they're claiming a financial loss and a breach of duty on behalf of the associations for the decision they made to close the pool. So we wouldn't pay for bodily injury under the D&O, but the D&O should respond to a defense or in a case like this. So that's COVID in your insurance policies. Any questions on that? Nope. Okay, you guys are nice to me today. All right. Performance bond. All right. I'm kind of going all over the place today with insurance topics because whenever I give a class, and I haven't given one for a year, I make notes throughout the year of what are the questions I'm getting, what are the most common questions that you managers are dealing with and trying to figure out. So a lot of associations are they're doing a lot of work right now, whether it's redoing your roof, redoing your concrete balconies, a paving project, a clubhouse redo, and you're hiring contractors, okay? And most of the time, you know, the contractors work out and job does good and all of that. But every once in a while we run into where the association and the contractor have a disagreement over how the work was done, over the time frame it was done, over the payment of the quality of the work, and it becomes a back and forth, and the contractor then brings a lien against the association or a suit against the association or something like that. Well, unfortunately, this is not an insurance issue. If you have a disagreement with your contractor, if it's not related to bodily injury or property damage, and it's just a related issue to you don't like the way they performed or they didn't finish their job, this is a performance issue. And unfortunately, your general liability policy is not going to provide you coverage for that in most situations unless there's bodily injury or property damage. And your D&O won't provide you this as well unless there's some claims arising out of it, like a unit owner sues the board for it. So how do you protect yourself? Well, you get a performance bond. Okay, a performance bond, unlike insurance, assures the association that the contractor, even if the contractor goes bankrupt or cannot competently perform to complete the contract, that they will get paid. In addition, the surety, which is a bonding company, can be required to pay the association claims for work not properly performed. So in the event that your contractor goes bad, leaves the job and doesn't finish it, the surety will step in and finish the job, pay to finish the job. Or if the job isn't performed competently, the surety would have to pay to finish it according to the contractor. Okay, many associations don't require bonds. I recommend them when you're doing a large project and there's a lot of money at stake. So in the event that something goes bad, the association's not holding. holding money or a lien or something like that. So the issue is that the contractor will pass on the cost of the bond to the association. So many associations look and say, I don't want to pay that premium for the bond, because it could be expensive. It could be 3% of the contractor amount. So if you have $1 million project, the bonding company may say, hey, I want 25, 30 grand for that bond, and the contractor has to pass it on to you, because they can't just eat the bond costs. So many associations bypass the bond. If you are going to do that, and that's your and that's your decision, and not my recommendation, but your decision as an association, you want to see if the contractor is a bondable contractor, if they can even get a bond, because the bonded contractors typically have to go through a intense underwriting for them to get a bond, meaning that it's harder to get a bond than a bank loan, put it that way. So the surety company underwrites the bond based on how they pay their subcontractors, how they pay the bills, how financially solvent on them, and typically most of the bonding companies requires the owner to be the guarantee personally for the bond. So they have at stake here. If a bonded contractor goes bad on a bond, they typically have to pay the surety company. So it's not like insurance where you have a loss, you don't pay the insurance company back. If you have a bond loss, the bond guarantee is paying the surety back. So you may want to check, and if you're not requiring a bond, get a letter from the contractor saying that they're bondable up to that amount, because that could kind of tell you a little bit about their business. Okay, so that's a free advice for y'all today. All right, importance of a bond, performance bond. Okay, another hot topic. Okay, transfer of risk. We talk about this a lot. I get a lot of associations that say, hey, I only use insured subcontractors. Okay, great. I certainly hope you do. That's part of your getting insurance through the insurance company. The application asks, do you use insured subcontractors? So most of your associations are all using insured subcontractors, and you as managers do a really wonderful job making sure they have insurance. So kudos to that. The insurance companies are really, for the associations, are looking for a little more than certificates of insurance, because when you get a certificate of insurance, all that does is it simply documents that contractor has insurance coverage that is in effect. And all it does, it tells you the specific dates of coverage and the lines of business. It shows coverage was in force, who the carriers are, and the limits of coverage. You are not getting any rights to the policy as a certificate holder. No rights to the policy, okay? You're simply receiving a proof that those insurance policies and limits exist that day. Okay, when you ask for a certificate of insurance and you ask to be an additional insured status on the policy, okay, this provides the association with insurance coverage and rights to defense under that subcontractor's policy. So you're actually, certificate of insurance does nothing except shows you they have insurance. Additional insured status says, association, if we mess up, we're going to give you the rights of our policy and defense under our policy. So this is really the recommended route to take when you're hiring subcontractors for your association. It's very common. It used to be where insurance companies wouldn't give you basically the additional insurance language, or they charge you an astronomical fee for it. In the industry, it's pretty common that all subcontractors can get additional insured status for your associations or for your management company in the event a claim arises out of their actions. So, got a question. Okay, good question. Bob, you have all the good questions. Okay, what is the association liability when you hire a contractor that is work comp exempt? Okay, so one of the things on exemptions with work comp, and let me just finish this thought on additional insurance. So, real easy. If you have a vendor especially maybe your landscaping vendors or vendors that are doing work on a regular basis. Get them to give you an additional insured status. That way, if they mess up, meaning I'll use an example, your landscaper, a rock flies out and hits someone in the eye while he's mowing. Well, that person is going to sue the association because the association hired the landscaper. Okay, that's just the way it works in the real world. Then what happens is, if you have the additional insured status, you as an association can just pass that on to the landscaper's insurance because you've been listed as an additional insured. So you're going to get the rights of his policy and the defense under his policy. So your liability policy doesn't get affected. Very common to do that. One of the things you want to make sure when you get this additional insured status is you want to review it, because many of them will give a blanket additional insured, and that's perfectly fine to get blanket additional insured, but you want to make sure the language in that additional insured status provides you. Most of them say that we'll give you blanket additional insured as long as you have a written agreement with that subcontractor. So it's really important that you have some type of contract or written agreement with that subcontractor for them to perform work on your behalf. In regards to workman's comp and liability workers' comp exemption, hey, we live in Florida. One of the things in Florida is they allow companies with 4 or less employees not to have insurance, and they allow owners of companies to be exempt. In the contracting field, it's a little bit different, where they have to have comp. If they don't, they can exempt as long as they're an officer of the company, and then they can't bring a workers' comp claim. From a liability standpoint, I'm not an attorney, so I'm not going to tell you whether you're legally liable or not. That's going to depend on the situation. But what I will tell you is, if you hire a exempt subcontractor, it could only be that that person, because the exemption doesn't follow a company, it follows the individual. So let's say you hire my company, ABC Tree Removal, because the tree guys are famous for this. I bring up this example. And I say, I don't have work comp, but here's my work comp exemption, manager. And you get my exemption that says ABC Tree Company, Tom Coaches, exempt for tree removal. So I roll up there that day to do the work, and I have 20 employees with me. Okay? All right. I'm exempt, so I can't come after the association. All right? But my 20 employees, unless they have an exemption with their name on it and they're a corporate officer of my company, they're not exempt. And I haven't provided you proof of insurance coverage. Therefore, the association has an exposure there, okay, for work comp. So if Jimmy falls out of the bucket truck and he has no exemption and I don't have any coverage, sure, Jimmy's going to sue me because I'm his employer, but I'm a tree guy in a truck. I don't have any money. Come on, Jimmy, come after me. He's probably going to sue the association as well. This is where your workers' comp policy picks up, if you have a workers' comp, if any policy, and I recommend that. Using the exempt subcontractors is perfectly okay as long as you monitor them. You know, it's usually your smaller contractor, maybe the guy who's cleaning the bathrooms at the pool, and it's only him. He never brings an employee on. You have a written agreement with him. That's fine. Another thing when they're exempt is you want to make sure that the exemption is valid, because they have to renew those exemptions like an insurance policy. And also, you have to look at the exemption and make sure that they're exempt for what the exemption says it's for. So if I'm Jimmy cleaning your bathrooms, but my exemption says I'm exempt for roofing, if I get hurt while cleaning my bathrooms, I'm not exempt for that. So you have to look at the exemption and what the exemption is there for. So I hope that answered your question. I got another question. Under what circumstances would a management company indemnify and hold harmless the association? That's a legal question as far as hold harmless and indemnification. That's pretty typical though. The management companies, most of the contracts out there, and I don't want to get into specifics, but as a manager, you're working on behalf of the association at the board's direction and discretion. So what happens is most of the management companies want to be included in on the association's insurance policy, and they want to be basically indemnified. So in the case that there's a claim, the management company is in the definition of the insurance for the association. It's always good to transfer risk as a manager, since you're working on behalf of the board. You want to make sure that the decisions you make, you're protected by them, okay? And it's their insurance primary. Did I answer that? Okay. Andy's trying to help me here. There we go. All right. Any other questions on transfer of risk? Okay. We are moving right along. All right. So now we're going to get into the devil's in the details. Okay. We talked about endorsements a little bit so far. Okay. So an endorsement on a policy is sometimes referred to as a rider. Okay. You may hear that. I have a jewelry rider on my home, or a rider. Okay. So in insurance, the endorsements are something that the insurance companies put in there that amends a policy in some way. So you have your basic insurance policy and your basic form, and then an endorsement will amend that policy in some way. There's different types of endorsements. An endorsement can add coverage, remove coverage, or exclude coverage, and it alters the scope of the policy. The endorsements can be issued in the middle of a term, a purchase, whatever. The endorsement is a legally binding amendment to the contract, to insurance policy. So if you have that communicable disease endorsement on your general liability, that's a binding amendment to the policy. So it means that in the event a claim happens, they're going to pull that endorsement and say, look, here's your endorsement or exclusion. We don't have to cover the policy. So you have an endorsement, okay? Where do you locate the endorsements? As I talked about, I don't want you to become experts in interpreting the endorsements, but you need to know where to find the endorsements. So when you're looking through your insurance policy and trying to compare apples to apples, which you guys like to do, you want to look in the back of your policy, okay? Well, you want to look in two places, okay? The deck page of your policy is going to have a list of the forms. So your declaration page is going to list the limits of coverage, and then the second page of your deck page is going to have all these forms listed here, and I'll kind of show you. That's what it looks like. That's what your deck page looks. And if you look all up and down these forms, these are the forms that are in your policy. So these are all the forms that make up the policy. So these are endorsements. You'll see like a commercial general liability, extended liability endorsement. Okay, here's another policy that you'll look at. Okay, so these are all endorsements. You'll see lead contamination exclusion, asbestos exclusion, fungi exclusion. So these are the exclusions that are in the policy that you need to look at when you're reviewing it. So then you can look side by side and say, okay, this policy has this policy doesn't have this, okay? So that is the declaration policy. If it's provided in the middle of a term, they're not going to be in that declaration policy, and they're going to mail it to you. So let's say you change your coverage, you get an appraisal, and you call your agent and say, hey, I need to up that coverage from 2 million to 3 million. You'll get an endorsement midterm. It won't show up on the deck page, but they'll send you that endorsement, okay? Okay, so you see the forms, and then you see them listed, but now you want to know what the form looks like. So that's when you go to the back of the policy, because that's where they put all of those endorsements and exclusions and all the good stuff. So in the deck page, you see what the form is, and then you go back to the back of the policy to read what the form is exactly. So that's the deck page, and this is a deck page for a work comp policy. Okay, so types of endorsements. Let's talk about that real quick. We're going to blow through this. You have a standard endorsement. A standard endorsement is basically drafted by an organization such as ISO or NCCI. ISO is the Insurance Services Office. They put out standard endorsements like your fungi endorsement or your nuclear endorsement. Those are endorsements that are standard and readily available, so the insurance companies don't actually write them. They're accepted. We call these standard endorsements because they've already been tested by the courts. So in the event that an association tries to contest one of these endorsements, they're going to have a harder time on a standard endorsement because these have already been approved and gone through the court system, okay? Some examples of standard endorsements. And this is still on our policy, the Y2K endorsement. I remember back in, for those of us who have been at this for a while, these all came out around 98, 99, and the insurance companies were afraid that we were going to have all these Y2K claims, and they never happened, but they still put this on every policy, a Y2K endorsement. So maybe they know something we don't. Okay. A non-standard endorsement. Okay, this is an endorsement that's drafted by the insurance company, and it's created for various reasons. So if it's not an ISO endorsement, you know, it's a non-standard endorsement. So the insurance companies can do this for a couple reasons. One, they want to set themselves apart from their competitors. So it could be a good thing that they add. The other thing is they may create it for a specific reason pertinent to the specific policy. So if you've had some claims for a certain thing, they may endorse a policy to say, we're paying for all of these perils and they'll exclude this peril or something like that. So the non-standard endorsements, you really have to read through them and make sure they don't sneak those in there, or if you do, you need to know about them. Example of a non-standard endorsement is basically, I hate this one, and you'll see this is a limitation on swimming pools and swim areas. So they're basically, this endorsement is scary because it says this insurance does not apply if bodily injury, if the pool rules aren't posted, if there's no signage, if the water depths aren't clearly marked, if the drains. So if you don't have all of these things in place at the time of loss, they can deny the claim at the pool. And how we tell this is a non-standard endorsement is if you look down here, this is a company, Cap Specialty. So they wrote the endorsement, okay? All right. So whereas with a standard endorsement, it's going to say ISO. You're not going to see the company name on there. So you can always tell that way. That's a little way to tell whether you have a standard or non-standard endorsement, okay? Endorsements are also based on purpose, okay? So the purpose of endorsement, I hate these. These are exclusions. Endorsement is intended to exclude coverage for certain types of claims. Some examples of these exclusions are fungi, bacteria, terrorism, nuclear energy. These are your standard exclusions. So they exclude coverage. So if we have a nuclear energy attack or terrorism attack, your policy is going to exclude these. We know they're standard because they say ISO and they say excluded. So these are your standard exclusions, okay? Added coverage, this is done by endorsement as well, okay? And this is used to add a type of coverage that is not provided in the basic policy. Typically, these are pretty good because they're giving you back coverage that the policy excludes. So you may see things such as hired and non-owned auto, which we like to have on all policies. So general liability policy excludes auto. So if you want your hired and non-owned auto, that's done by endorsement. So you're going to see a hired and non-owned auto. You're also going to get additional insured endorsement, giving coverage to whoever the additional insured is, whether it's a, you know, and this is what your subcontractor is going to do. They're going to add you by endorsement to their policy as an additional insured. And sinkhole. Sinkhole is excluded in the coverage form, but it's given back by endorsement. So these are how they look, and you'll know ISO, standard endorsement, standard endorsement, standard endorsement, sinkhole coverage. All right, ISO. All right, so any questions so far?
Back to the home harvest, there is one.
All right. Okay, management companies want associations to, but some management company agreements do not. Yeah, Mitch, that's more of a legal question for your association, because when it comes to hold harmless and indemnification, yes, the insurance policies provide that, but the request to do this from a management company and association is between them. And I've seen where associations ask for management companies to indemnify them. That's going to be an agreement between the two parties. on that hold harmless and indemnification. It really doesn't deal too much with an insurance nor the insurance policy, so to speak. Okay, so you really need to figure out with your legal counsel why the management company is asking for this and vice versa. So, but that's usually in the management agreement you have with them. And because it's a written agreement, your insurance policy is going to typically honor the written agreement. Okay, so categories of endorsements are based on purpose. Okay, so we talked about modification. Examples of modification: when we change midterm, you may have a change in valuation, a change in deductible, or the insurance company may go out there and they see that the property is vacant and they'll put a vacancy endorsement. Be careful of this. Doesn't really exist too much with association, so not that. There's other purposes. There's editorial changes, notice of fees, advisory notice. Those are in all the policies. Kind of give you an administrative changes. These are changes that really, these last two don't really change the policy. But I'll give you this one. This is actually, I deal with this all the time. So let's say you change your management company, or you change your address, or the board members change and they want to be listed on the policy. So you would make an administrative change to the policy, and that's actually done by endorsement. So if you're a management company, you're taking over a new association, you're going to contact the insurance company and say, hey, you know, ABC, I'm ABC Management Company, I'm taking over October 1st, please make the change. You're actually going to get an endorsement on the policy showing that administrative change. So that has to be it'll come exact from the insurance company, the change, and it'll be part of the policy. Okay, so this kind of gives you an idea of this. So this is one of those changes where we change the value. So this is an endorsement. We got a new appraisal. They said increase it. So the new policy limit. Here's your additional premium. That's an endorsement adding coverage. Here's your vacancy endorsement, which says, hey, if your building's vacant, we're not going to pay. They changed this midterm. They slapped that on there. Okay. Here's your editorial change. You'll see this. It's about fees and stuff like that. That's an editorial change. And here's your administrative change where they'll change the name insured. Okay, so we are now going to go into I'm just going to run through some types of exclusions with y'all that we see in policies and endorsements. Existing damage exclusion, you'll see that. It basically says that they don't want to pay for damages that exist or things out of workmanship or lack of repairs. That's a pretty standard exclusion in all policies. Ordinance of law, this is an endorsement, not an exclusion. This is something that you want to check your policies. We always talk about ordinance of law because ordinance of law is typically not included in the property form, so you have to buy some coverage. This is what that endorsement looks like to add coverage. You have this is an exclusion in a lot of policies. They don't want to pay for athletics. So your association has a softball team. Well, they don't want to pay for Joe's knee when he pulls a softball. Really interesting to read this exclusion because if you read it, this exclusion only applies to bodily injury while practicing or participating in a sport, athletic, or exhibition that you sponsor. Because people always get scared that, oh, I don't have exclusion if someone gets hurt on the tennis court. No, you have coverage for that unless you're sponsoring the event. So I tell associations, if you're sponsoring a neighborhood tennis tournament or a softball league and you have this exclusion, we need to talk. If it's just, hey, I have a tennis court or a basketball court and they're playing pickup games, you have coverage in the policy because you're not sponsoring that event. Okay? Special activities exclusion, you'll see this in policies. A lot of policies will have like, hey, we don't want to have shooting ranges, skate parks, or this. So you got to watch out for that exclusion. Here's your limited or fungi bacteria coverage. This isn't an exclusion, okay? So I love insurance policies. They love to confuse you. Insurance companies, all of them, they love to confuse the policyholder. So what happens is they'll put on a exclusion for fungi or bacteria. So in your policy, when you're reading it, there's an exclusion for fungi or bacteria. But then 2 pages later, you see this, which is limited fungi or bacteria coverage. So what happens is they've taken the coverage away totally, but in this endorsement, they give it back. So they'll give it back on a limited basis for limited type things. So this is a good thing to have on your policy, because this is an endorsement adding back in coverage. And a lot of times you'll see a limit up here of $50,000 or something where they actually give you the coverage back. Okay, so insurance companies love to take it away, but sometimes they give it back. So you'll see this a lot with your fungi and bacteria coverage. This is a really good coverage as well. This is in your workers' comp policy. This is your volunteer endorsement. That's done by endorsement. It's limited to active board members and members of the association. So people ask all the time, well, we want to use volunteers at the association, okay? And we have a work comp policy, okay? I tell them, that's great. I'm glad you have a work comp policy, but do you have the volunteer endorsement? They go, I don't know. We bought a work comp policy. You need to look at your policy and make sure it endorses this. You want to make sure you have some type of language in that policy that shows that the board members and the members of the association, while in the course of volunteers, are covered. Because if you don't have that and a volunteer injury happens to volunteer, you don't have coverage. So just having a work comp policy is not good enough. You need to have the volunteer endorsement. Okay. EPLI, this is an exclusion. All policies exclude this, but you're going to get this back in your D&O form. Water exclusion, this is a change endorsement. Chinese drywall, this kind of gone away, but this was an exclusion that they were putting on there for a while when that was all hot and heavy when Chinese drywall was happening. Subsidence exclusion, PCB. And I use this one because no one knows what it is. They go, what is PCBs? I have that on my policy. Okay, so when you get something like that, you call your agent and talk about what does that and does it apply. This is dealing with chemicals and pipes and stuff. So most of your associations don't have this, but it's good to know that you have an exclusion if you do have it. And this isn't a regular exclusion that we see on every policy. So, but just if you have it. EFIS is pretty thing, vacancy permit, total pollution. Amendment of liquor liability exclusion, I like this. You have most of your general liabilities have a liquor liability exclusion, but then they give you the coverage back. Okay, so they amend the exclusion. So once again, they take it away, but they give it back. So they're saying, this insurance policy does not apply, okay, unless the exclusion applies only if you manufacture, sell, serve, or furnish that requires a license. So this is your host liquor liability. You want to make sure you have this and make sure you follow the rules of the exclusion. Okay, any questions on exclusion?
No, there is one question.
Okay.
Are we to update our agent of the new board members' names?
It's not necessary because the policies don't define named insured. It just says board of directors. So they're going to have protection under that. Some companies like it updated, but it changes so much. It's not necessary to have that done. They're still going to have coverage as long as they're a duly appointed or elected board member. They're going to get coverage under the policy even if we don't have their names. Okay. So, but there are a couple companies on the D&O coverage that do require the names of the board, but we've rarely run into that. So, all right. Warranty and insurance policy, talk a little bit about that. A warranty is a statement or a fact given to an insurance company by the association. So basically, a lot of companies say, we will underwrite your policy only if the association has this, okay? So the association then says, yes, we have it. And then the insurance company says, okay, we're going to insure you only if you have it. If you're telling me a lie and you don't have it, we're going to void the policy. So this is called a warranty, okay? So the warranty is undertaken by the insured that will, shall, or not do a certain thing unless things are provided. So basically, if you tell me something and it's a warranty on the policy and it doesn't exist and there's a claim, you're not going to have coverage. Example of warranties. The most common example is your protective safeguard warranty. If you tell me you have smoke detectors, or you tell me you have a fire sprinkler and you don't, at the time of loss and you have a fire and there were no fire sprinklers and you told me on your application that you have fire sprinklers, the insurance company is going to say, I would have never underwritten this. It's a warranty of the policy. You misrepresented. I am not paying the claim. So it's very important that you understand what the protective safeguard warranties are in your policy. Most of your safeguard warranties for associations, for condos, if you tell them you have a sprinkler, it's going to be listed here. If you tell them you have smoke detectors, it'll be listed here. So that's why we always ask the question, do you have smoke detectors? Do you have sprinklers? Are they monitored? Blah, blah, blah. So you want to make sure that you're not in void of the warranty. The other thing is swimming pools. This is that endorsement I showed you before. So basically this is a warranty. So they're saying if you don't have these 7 items and you telling me you do, we're warranting the policy. I'm not going to pay a claim at that swimming pool if these aren't in existence at the time of loss. So be careful with warranties, okay? Now a representation is different than a warranty, okay? So when I go through the applications, or your agent goes through the application and talks about what you have, you answered yes and no to this questions, okay? So you make a representation that you believe is substantially true, okay? So, and then a claim happens and the insurance company finds out that you didn't tell the truth, okay? So what happens then is, you know, is the claim paid? Well, that's going to depend on if the claim was caused out of the representation. Some examples of representation questions may be, do you have aluminum wiring? Do you require all subcontractors to provide proof of insurance? Does the association allow short-term rentals? Do you have any knowledge which give rise to a claim? Do you require counter signatures on checks? So here's how the applications look, and when you answer yes or no. Okay, representations are if you have a claim and you represented, like, so let's say you have a fire claim, okay? I use this, and it's a kitchen fire, okay? And I left my stove on while I was cooking, very common in condo associations. And damage happens, and the insurance company comes in and says, you had a fire here and you told me you had aluminum wiring. That was a representation, right? Okay. They still have to pay the claim because the aluminum wiring had nothing to do with the cause of the fire, okay? But now if the fire was caused by aluminum wiring failure and you represented that you had it, then they could get off the claim by misrepresentation, okay? So representations aren't as material as a warranty. A warranty can just say, if you didn't have the smoke detector at the time of the fire, I don't care what the cause is, I'm not paying the claim. Representation says that your representation had to have added or caused the claim to occur. Okay, so just because you allow short-term rentals, if you answered me no, and a claim happens because I'm an owner and I fell over the sidewalk, the insurance company is still going to have to pay the claim because the short-term rentals didn't contribute to my loss. So, any questions on representation warranties? Good. All right. So these are examples. I always really the one representation I hate in the insurance companies deals with, and I just use this as an example that all the companies do it. On the D&O app, is any person proposed for this insurance aware of any fact, circumstance, or situation that may give rise to claim? This is a directors and officers application. This question scares the heck out of me because people argue at associations every day and they threaten lawsuits every day. So how do you answer that question? You know, if Mrs. Smith called me to complain yesterday about the color of her grass, is that a circumstance that gives rise to a claim? So I had one insurance company, I won't name the name, that actually the board answered this no, because they didn't have any fact that that there was a claim out there. And then they actually were sued by a unit owner for breach of fiduciary responsibility or whatever it is. And then the insurance company came in and said, we're denying the claim because you knew about this. And the board goes, we didn't know about this. And they go, well, hasn't the unit owner, you know, complained to you before? They're like, yeah, he's been complaining for 8 years. Has he said he was ever going to sue you? Yeah, he's been telling us he's going to sue us for 8 years and he never did. So I don't like this question in the applications. I actually tell a lot of my associations to leave it blank, or basically talk to their agent about it so the agent can make the carrier aware. Most of the companies are pretty good on this, but you know, I have the one company and you have the one, and it scares you because the association was absolutely right. They didn't think there was a claim. They didn't know about it. So here's a representation. You'll see on your thing, are all pools areas fenced with self-latching gates. I highlighted this because, folks, your associations better have self-latching closing gates in their pool. This is the one thing that all the insurance companies want, and they want to make sure you have. You know, you'd be surprised how many associations I go out to visit their meetings, and they're having it at their pool area, and I go in and there's no latching or locking on the gates, and I have to tell them at the meeting, hey guys, get your gates fixed. It's a big thing with insurance companies. If they come out and do an inspection, they'll cancel you. Or if you know their gate's not working in working order, and you say yes to this, and then you go to deposition and they say, oh yeah, I knew for 3 months it wasn't working. Well, why'd you answer me yes? Make sure your gates are working on your pools. Those are our big claims at association. I mean, we're gonna have our slip and falls, but a pool claim is a big number if someone gets hurt at the pool. So make sure you do that. Talked about this a little bit. We already talked about this. All right. Fun part of the thing, and we'll roll through a couple of these and I'll let you go because we've been at it with no break. So association general liability policy contains a communicable disease exclusion. Unit owner demands association reimburse for medical expenses and lost wages due to the effects of Legionnaire's disease contracted in the sauna located in a clubhouse. Is reimbursement for medical bills covered or not covered by the general liability policy? Well, it would be covered if you didn't have this communicable disease exclusion, but you have this on the policy, so the insurance company is not going to cover those. They're gonna cite this exclusion in their policy. If this didn't exist and there was no other exclusions that existed in the policy that would cover this exclusion, you would be afforded coverage. Okay, here's a look at what a communicable disease exclusion looks like in your policy. So basically, you know, when you read it, it'll tell you what it is. So, all right, covered or not covered. The association's property insurance policy contains a protective safeguard warranty, which states the association has hardwired smoke detectors and a central station alarm located in the units. Fire occurs on a premises, and upon investigation, the association's central alarm was disconnected as the association did not renew the service. Is the fire damage covered or not covered? Guys, I'm afraid the insurance company may not cover that because you told them they had a central station alarm system. It contained a warranty, a safeguard warranty, which says in order to have coverage, you need to have this in your policy. And you knew because you disconnected the service. So the warranty wasn't met, you're not going to get coverage for that. Had an association do that. Luckily, I didn't have a fire, but they called me and goes, oh, we disconnected that central service years ago. I was like, whoa, hey, you got a safeguard warranty in your policy that says that. Now they said, well, what can we do about it? I go, well, there's two things you can do. You can go hook up the central station alarm, or we go to the insurance company and have them remove the safeguard warranty, which they agreed to do. But in order to do that, they took away a credit for having the sprinklers. So a lot of times, if you have a warranty and you don't meet the warranty, a lot of times the insurance company says, you know what, we're still fine with underwriting it, but we're going to charge you a little bit more because we have more of a risk of a claim. Okay? Association hosts a New Year's Eve party at the community clubhouse in which residents serve dinner and an open bar, and they charge $25 per ticket. One of the guests, and this has never happened, come on, one of the guests becomes intoxicated and causes injury to another individual while driving home under the influence. Association has a general liability policy which provides host liquor liability. Claim is brought against the association and board for overserving the individual that caused the accident. Does the policy provide coverage? Okay. Here's one where I don't know. Okay. You have host liquor liability. Okay. But the policy says, if you read the policy form, it says that you can't be in the business of selling alcohol or charging a fee. Okay. So my concern with this whole ticket charge, $25 for a ticket, does the insurance company come in and say, you are now in the business of selling alcohol, I don't want to pay the claim? I think courts will decide on that, but I don't want to risk it. So I would say you're on the side of safety and don't charge for alcohol. Because if it's BYOB or you're giving it away free, you're going to have coverage under the endorsement, the host liquor liability endorsement. All right. Association has a general liability policy that contains a swimming pool limitation. Child becomes injured at the pool and parent claims gates were not secured and operational at the time of the accident. Does the association have coverage for this incident? Not if they have the swimming pool limitation, because that's going to say your gates have to be self-latching. I mean, the gates really, folks, if I could tell you one thing at your association to make sure you continue to keep up on and make sure that maintenance is checked on them, to make sure those gates are working. They're self-latching. They don't have to be a locking gate. They have to be a self-closing and self-latching. Springs rust out. I know they break from time to time, but they need to be fixed. Or, you know, I love the one. I went out to one association to a meeting, and they had the gate propped open with a concrete block. Well, how's that going to go over in court? You have our self-latching gates work, but we put a concrete block there so people could come get in and out. Folks, follow the rules on this one, you know, please. All right. Association hires firm to apply fertilizer to plants and shrubs during the rainy season. Fertilizer washes into a nearby pond, causing an algae bloom and damage to aquatic life. Cleanup and damage exceed $50,000. Is this covered under the general liability policy? Heck no. All general liability policies are going to have this total exclusion liability, total exclusion pollution. I'll get mixed for words, but you get the point. You have to buy a pollution policy to get this exposure covered. So I know many of your agents are talking to you about that. It's a good idea. We used to not sell a lot of it because it was really expensive, and the associations would weigh the risk. Do I want to pay $4 grand for the risk? Pricing has come way down. So I recommend that, suggest that your associations definitely look at this as a possibility. Association provides insurance to the insurance carriers that have an insurance wiring, loss occurs, and unit owner leaving the stove. Is a claim covered or not covered? So here we talked about the warrant with aluminum warrant, representation or warranty. Loss occurs from something else. Is it covered? Sure, it's covered because it didn't cover from the wiring. Okay. We've got about 10 minutes left, but we didn't take a break, so we're in compliance with getting this done. Is there any questions or anything I can help you with or answer you? As I would be glad to do that at this time. I know everyone's probably wanting to get to lunch, and we have been at it for a while with no break. So we fulfilled our obligation to the state. That went, time flew by quick there too. I was wondering how it would go on this type of setting, if the time would fly by like it does when we're in person classes talking, but it went by pretty quickly. So any other questions or things I could help with?
Should a volunteer group have liability insurance from Karen Price?
A great question, Karen. If the volunteer group is part of the association and is a approved committee of the association, then they're going to be covered in the definition of an insured by the association. If the volunteer group is a separate entity with their own FEIN number and separate corporate documents and all of that, then they should explore having their own insurance policy. Good question.
Christina said she'll email you later with a question. Colleen just said everybody's saying thank you.
Oh, no, thank y'all for letting me do this. I enjoy this, and everyone stay safe and healthy, and special thanks to Karen for putting this together. I appreciate it, and walking me through the technology, because I could have never figured it out. And Annie for being here. She sat next to me the whole time, just in case. Annie, wave, come on in.
Well, I just want to say thank you,
She
guys.
sat here the whole time, just in case I messed up the technology. So
Thanks, Tommy, and thank you, Annie, for making sure he stayed safe in his presentation there. I appreciate it. Just a couple closing remarks. Please fill out the evaluation form that was sent to you yesterday with the handout and return them to me at my email address, karen@caiwestflorida.org. I sent it to you, so you should be able to find my email address. That way it gives us a chance to give Tommy feedback on anything that you want him to know. And the other thing is if you sign up for tomorrow's class, after this, we sign off here, I'm going to be sending out the link and the handouts and the evaluations for that. If you're signed up for multiple classes, I don't want to send too many links at one time and get everybody confused. So with that, and also just another aside, please give us a few days to get your credits reported to the DBPR and to get you your certificate. My assistant Laura will work hard on getting that done, and we promise we'll get them done well before when you need them to renew your license. We'll get them done in the next few days. So with that being said, does anybody have any questions, any more questions for Tommy, anything at all? And if not, thank you so much. I greatly appreciate it.
all right.
I think we're done, Tommy.
All right, thank you.
Thanks, everyone.